How's it going, everybody? My name is Antonio. Thank you for being here. You're about to watch or listen to another one of the 2023 Outlook series episodes. On this one, I'm joined by Will Thomson, who is the founder of Massif Capital. That's a hedge fund focused on investing in real assets, materials, energy, industrials, stuff like that. Who I'm not joined by, though, is your financial advisor. They're not present here today, and this will be a conversation that's general and impersonal in nature. One that will not include any financial or professional advice whatsoever, but it's probably going to include a lot of forward-looking statements, stuff that you should never blindly trust, and you should always double, triple check what somebody on the internet says. That all said, Will, thanks a lot for investing your time with me.
Absolutely. Happy to be here. So looking forward to the conversation.
I am looking forward to it as well, because we were chatting off mic. I've been trying to talk to more people from within the industry who actually manage real money and do real work in the industry, and I have not had too much success getting people on. They would say like, oh, I don't want to spill my strategy and lose my edge over the market and stuff like that. So why would you agree to talk to me?
I think look, a lot of people think they have a very unique strategy. The reality is that very few of us truly have a unique strategy. The edge we have as money managers is more about our judgment. That is, in the end, what the business is. It's about collecting, and however you execute, you're collecting information from publicly available sources that everyone has access to, and you're applying your judgment to it. And so the secret sauce is really in the judgment. It's not in how some manager articulates their supposed strategy. And that judgment call, you've got people like Warren Buffett. Warren Buffett has been very explicit throughout his entire career about what his strategy is. Nobody's been able to duplicate it, though. Why? Because, again, the secret sauce is in the judgment. It's not in the articulation of the strategy. He has told us how to go about doing what he does. Doesn't mean we can do it. Admittedly, there are probably some unique derivative strategies or things like that take advantage of market flows and things, or algorithmic strategies where there are nuances that probably you don't want to share because you don't want too many people doing whatever it is you're doing. But in my opinion, in general, we're all playing with the same information. It's a question of how we interpret that information that makes the difference. And that is not something that I can necessarily, I can explain it to you in individual instances, specific cases, but it's not something that I can say, explain to you in a giant framework that you can then take and deploy without issue. You haven't had my experiences, you haven't had my trading history, etc. And so the judgment call that I bring to the information I'm presented with is really what makes the money. I think that the managers you talk to might be deceiving themselves a little bit in thinking that how they're executing their strategy in the market represents edge. The reality is that their edge is in the judgment calls that they're making. And they may or may not have edge there.
I guess maybe it also depends on what sectors you dabble in, or does it not? Like if you're in a relatively illiquid sector, you don't want to spill your strategy, maybe.
Yeah, it's a possibility, but again, I think there are plenty of illiquid sectors of the market, and just knowing that a sector is illiquid and that there's opportunity there is not sufficient to make money. You still need to collect the information and have a forward-looking statement or thought process idea about what's going to happen. And that, again, is going to boil down to how you interpret the information you've collected and the mosaic that you sort of paint, the picture that you paint about the future. So, definitely would rather have less competition than more in certain sectors. But in some regards, it probably doesn't matter if your judgment is superior. I flatter myself in thinking perhaps my judgment is superior, or we generate pretty decent returns. But that's, at least in my opinion, really where the secret sauce is.
Okay. You say decent returns. I guess is a good point for me to ask you about that. What is decent returns? And also, if you feel comfortable talking about how much money you manage, to sort of give me in the audience an idea of how big the fund is.
So just a little background, sort of paint the whole picture for you. So I started Massif Capital on my own with $250,000 of my own in 2016, the second half of 2016. I then built the business, brought on some help in the form of a friend of mine, a partner, in 2018. And we built up a business running separately managed accounts to about 7 million over the course of a couple of years. We secured a seed investment for our fund in 2021, rolled all the SMAs into that, and now are managing about 25 million. Decent returns in our mind. We aim to give our investors a net of fees return of 12% per annum. We haven't quite hit that mark at the moment. Right now, we're running at about 10% per annum since inception. As I said, not exactly where I want to be, but pretty close. And I think a decent enough return. I think if you're going to pay for someone to manage your money, I think you need to, you should sort of look for that 10 to 15% return, in my opinion. So over a cycle, right? Like we haven't done it consistently some years we're up 25%, other years we're up 5%, et cetera, but it all sort of evens out, if you will, at the moment to roughly a 10% return, which is no statement, as you noted, about future returns. So,
right.
Or guarantee.
But that's a good point, actually, because if you have somebody promising you more than 15%, you should be asking how they're doing it. And right. I mean, you should probably trust that.
Yeah, I think, look, I mean, some people manage to do it. And so you might find Stanley Druckenmiller, right? And, in which case, give them all your money. But of course, the odds are pretty limited. I think that when people start throwing up, if you start throwing up, I don't know, consistent 50% returns or something, and I know a couple of people who've done it recently, I think you do need to ask what they're doing, and a lot of what they're doing includes, more leverage perhaps than you might be comfortable with, or in one of the examples I'm thinking of, they placed a lot of bets on Bitcoins and cryptocurrencies and stuff like that, not with the expectation that they were worth anything, but with the expectation that there would be a greater fool, if you will, in the future to buy it from them at a higher price. And that's not a commentary on my part about the value of Bitcoin. I have no idea. It's not a topic I know anything about, just what their strategy was. And at least from my perspective, especially on the long side, I don't really want anything in my portfolio that I don't actively want to be in the portfolio, if you will, right? Like nothing goes in there that I want to get rid of at a higher price just because I think there's some greater fool out there to take it off my hands. It's a bit of a risky strategy. So yeah, I would tend to agree. Something like greater than 15%, sort of that's what they think they're going to do, and I would start to have some red flags, in my opinion.
Is that because it's not doable over long enough periods of time? But do you think it's possible for retail investors to do it for like a couple of years on their own?
Oh yeah. No, I mean it's definitely not. It's more of a. There are a lot of people that have. There are a lot of people that will. And it's not a question of it being impossible. I just think that if you're giving your money to someone and they're coming back and saying, yes, we think we're going to generate consistent returns above 15 or 20%, I think, that it's probably 20%. It's probably the better line. I think seems somewhat unrealistic to me.
What is in your portfolio? Because you mentioned you only have stuff in there that you want to own. Do you feel comfortable talking about sort of a breakdown in percentages?
Yeah. So, and I might just look off to the side here to look at my my sort of portfolio screen. So we divide our portfolio into sort of one third, one third, one third in industrials, energy, and materials. At the moment, and since the inception of the firm, in fact, we have been overweight that sort of one third allocation to metals and mining. We have consistently run more like 40 to 45% of the portfolio in metals and mining, the rest of it being split roughly evenly between energy and industrials. We also run a short book, and our aim is generally to have a gross of about 150 and a net of about 50. So we run a fairly large short book. The short book is not a hedging book. They're alpha-driven shorts, specifically chosen on the basis of their own underlying idiosyncratic sort of variables. Within the mining section of the portfolio, it usually tilts towards junior miners. We've just sort of have a background and history with them, and we find them to be a good pond to fish in. On the energy side,
I just want to interrupt you here. I'm sorry for a second, then, because it's what I suppose you mean when you say junior miners is the literal meaning where you're saying small miners, or like, because when oftentimes when I talk about juniors, to me those are the explorers and early stage developers, but you're further up on the Lassonde curve, right?
No, so development, that orphan period there after when we think about the Lassonde curve, and of course for your investors, it's sort of, there's a peak when there's a geological find, then it sells off. And during that sell-off, the company enters its development phase, right, and starts to build its mine. That's the phase that we really like to play in. Oftentimes the stock is trading down, but the risk, if you will, of the company turning on the mine is decreasing. And so what we're underwriting there is that ability to execute on the part of management, the building of a project. And we find there to be a lot of meat on the bone, if you will, to due diligence that question, to sort of explore, are they capable of doing this? And that really is what the bet becomes. The bet is not, any longer a bet on commodity prices or a bet on a geologist being able to find a deposit. It's a bet on the management team being able to turn on the mine. Not to suggest commodity price, again, is unimportant, but the bet really becomes, can these people, this management team, turn on the mine on time, on schedule, on budget, etc. And that's a bet we really like to make when we get a chance. I think the situations that are ideal, though, are far fewer and further between than people think. And so I would say that over the course of what are the 7 or 8 years we've been in business, we've made a total of, I think it's 16 mining investments, of which we've closed out 11. Of the 11 we've closed out, one we closed out with a loss. The rest have all closed out with in excess of 100% return. And of those that remain in the book, 2 are big winners, and 3 are just sort of neither here nor there. But that sort of gives you an idea. Like, we only pulled the trigger, 15 or 16 times over the course of that period. Like, you got to find just the right situation.
Okay.
So there are only a couple of opportunities a year, and you need to be ready to move on them.
I think this is what Lobo Tigre, I don't know if you're familiar with his work, but he calls it the pre-production sweet spot.
Yep.
That's what he dabbles in a lot. So it does make sense. Well, actually, bringing up newsletters, do professional money managers even do that? Because it's a big thing with retail investors, right? Relying on newsletter writers.
Yeah. I'm friends with a bunch of newsletter writers, and we talk and share ideas. I don't actually subscribe to any newsletters, but I think I don't think there's an issue with that being a source of ideas. I do find that my conversations with my friends, a couple of people I know who are newsletter writers, they put a lot of companies that maybe wouldn't be on my radar in front of me, and so I find that a great value. I find a lot of people really badmouth sell side research and newsletters, but I think, from my opinion, is that from an information content perspective, these are all great sort of sources of information, right? People think about the sell side and they badmouth it because the sell side says in a quarter it will be X. Some stock will be trading at X, or we think the company's going to 10 over the course of the year. You don't need to read their conclusion. Okay? You can just take all the work that they've done and throw out their conclusion. And so it's a great way, especially I would think for a retail investor, if you can separate the conclusion from the information, it's a great opportunity to accelerate your research process.
I think you make a very, very, very good point there. That's what I've been figuring out on my own too. A lot of people, though, to bring up something you just recently said, do play it in a greater full theory way, where it's mostly speculation for them, and like they don't really buy it because they think, oh, the asset is going to be monetized in that it's going to be brought into production, or it's going to be sold to a major or something along those lines. They do play the greater full theory, I guess.
Do I?
No. I guess a lot of people like me would do that.
Yeah, I mean, but look, there are a lot of different market participants, right? And we're sitting at a poker table, and we're playing against all those different market participants, and some of them are going to make decisions for reasons that are unrelated to anything that I think is important. And that's just the way it is. And that creates the volatility that we see, but it also creates a lot of the opportunity that we see, especially on the short side.
I've not forgotten, by the way, to ask you about what that 40% that's currently in mining is split in terms of sectors, and I'm gonna, when we get to that point. But before that, I would, because this gives me sort of an idea of what you're bullish on. But what about what you're not so bullish on, or maybe even bearish? You said you have a short book. Yeah. Like if this is a new question in my arsenal, but if I gave you $10 million and I was like, hey, Will, can you please lose that for me as quickly as possible in the market? What would you put it in? What would you go long?
To lose the money, I would. So it'd be a couple. I'm not sure if I've got one thing to put 10 million in to lose it in, but if we spread it around a couple of places, I think there are a couple of interesting places to lose money right now. One place that I think, and we've made money shorting, or lost money if you went long, is some sort of speculative new energy companies. There are a lot of narrative-driven companies like a Plug Power or a Bloom Energy. These are hydrogen fuel cell businesses that have been around for a couple of years, or in the case of Plug Power, multiple decades, and never made a dime. And there are some other companies. There was a company we shorted at one point that was a SPAC a couple of years ago that said we were going to make energy by taking renewable power when the sun shines, and lifting bricks of cement in the air. And then in the evening, when people needed power, we'd spin a generator by letting the bricks down. Like, this was $1 billion SPAC, right? The science didn't work. The idea was, I mean, in a lab, your middle school chemistry lab or physics lab, it works. It doesn't work at scale in the real world, though, right? So there's some new energy stuff that is driven by the excess enthusiasm, let's call it, around ESG, that are interesting places to lose money right now. I've got a lot of concerns about parts of the solar supply chain, not because I find solar to be a bad source of energy, but I believe solar has got a time and a place, right? So, for example, there was a recent study done that looked at the energy return on invested energy for solar panels in Finland. Okay, well, it was less than 1. That basically means that the energy put into creating the panel is more than the energy that gets pulled out of the panel over its life. So there are, now in Nevada, that's not the case, right? The sun shines. In Egypt or someplace like that, it wouldn't be the case. Spain, certainly not the case. But so there are aspects of the solar supply chain that I have concerns with, mostly sort of renewable OEMs right now. So wind turbine manufacturers, solar panel manufacturers, they're really getting squeezed. I think there's some dislocations there that are opportunities. And then US industrials have made some very interesting moves in the last, let's call it 6 months, where, we sort of had a period of time where we were hyper concerned with a recession. My concern with a recession remains. I think a lot of people's concerns have faded though. And during this sort of 6-month period, you've had things like US steel companies, move to all-time highs in some cases. Despite the fact that prices on steel have come down dramatically from their September peaks of last year, margins have compressed. You've got some other US industrial sectors that are just outperforming in a very dramatic way within the context of an economic environment that you're sort of like, I'm really not sure if this is a, sort of high capex industrial cycle sort of period of the economic cycle. So those would be a couple of places I would look to lose money. Some combination of those. I would also there's a couple of lithium producers that have talked a big game, and I don't think they'll follow through. And I think lithium prices are going to come down from their current levels. They've been quite high for a while, obviously. My outlook for lithium is quite positive, but that doesn't mean that in the meantime there aren't a couple of lithium producers that have promised too much and are going to fail to deliver. So,
you used to be bullish on tin too, by the way. I think you were in Alphamin at the early stages too. But it seems like production is increasing significantly when it comes down to tin. So you have Malaysia smelting, one of the biggest producers, looking to increase production massively. Alphamin just found even more tin. They're going from 4% of the total global production to now 6%. So they're increasing their production too. Do you think that high prices have cured the high prices with tin?
I'm not convinced that we're going to see those. What I think we saw as high as $40,000 a ton. I'm not convinced we're going to necessarily see prices back at those levels. But you look at something like Alphamin right now, and Alphamin's got a all-in sustaining cost of production of like $13,000 a ton versus $24,000 a ton on the LME. I think the high prices have perhaps cured a little bit of the issue, but I think there's a shortage. There remains a shortage. Inventory levels are, at least the last time I looked a couple of weeks ago, were pretty poor, and the increase in demand remains high, and the ability of some of these firms that say they're going to bring on supply to actually bring on supply, I think, is far more limited than people realize. I see a lot of tin studies talking about, we're going to turn this on at $30,000 tin. Well, we're at 24, so you're not going to turn it on. And so I think everything about the future production of tin, I think, needs to be taken with a big grain of salt. The Tin Alliance, I don't remember what it's called. The tin, basically the industrial the industry organization, which I believe is called the Tin Alliance or something like that. They have a supply and production curve outlook that one can find online. And a lot of the future supply that they pencil in, I would argue, is probably not actually going to be there. Turning on tin mines has proven more difficult, more time consuming, and more costly in the last couple of years than people have realized. And it remains a very small niche metal. Now, the problem with a niche metal, of course, is that if a big mine does turn on, you can swamp the market. So you do run that risk when dealing with niche metals. But I think the case for tin it remains pretty strong.
I think you're one of the first people who've approached it that way, where you say, hey, production might actually surprise to the downside, because most people would say, oh, just watch out, high prices are going to cure high prices before you know it. And especially so in uranium, which is the part of the market where I've managed to lose a lot of money so far, not necessarily because of the market, but because of my approach to it and my gambling addiction to explorers. But what about your uranium? Maybe talk to me there too.
Yeah. The challenge with looking at just the price and say the incentive price to bring production online is that it's a bit of a Excel spreadsheet sort of approach to thinking through things. And the reality is that when you work supply and demand potential, if you will, in Excel, a lot of things are possible. In reality, it's much harder than, say, the incentive price now is below the current price. There's going to be 5 years of time before the mine turns on, things of that nature. There's all these variables that go into the business decision besides for to build a mine or to search for a mine, or besides for just the costs and the incentive price and the current market price all seem to line up on an Excel spreadsheet. Now, in the case of uranium, I think that look, we're bullish on uranium long term. We tend not to make straight commodity price bets, but we did recently start a position in Sprott uranium. What do they call it? They don't call it Uranium Participation Corp anymore. That's
Sprott Physical Uranium Trust, the SPUT.
Yeah, yes, thank you. It was called the Uranium Participation Corp or something before Sprott took it over. But I'll go into sort of our thinking behind that in a sec. But that was more of a portfolio level decision rather than necessarily a company specific decision. I think, look, uranium's got a future. I think the future of nuclear is robust. I think that the most recent sort of energy experience that we've all been put through over the course of the last year with energy prices has hopefully turned a switch for a lot of people about what it's going to take to transition to a low carbon electrical grid and sort of the demands on physical plant and equipment that is required. And to do it without nuclear is a really significant challenge, in my opinion. So the potential for uranium is there. At the same time, it's a highly opaque market. And the insights people have into production are relatively straightforward and easy because there aren't that many mines operating. But the consumption side of things, the secondary supply side of things, the trading of uranium that goes on behind the scenes that most market participants don't know anything about really. There are a lot of variables in the price of uranium that just aren't appreciated beyond just supply and demand and the fact that the market doesn't clear without secondary supply. And so it's a very hard industry, in my opinion, to evaluate from that perspective. And there are a lot of people we rely on when we talk about and think about uranium who know this much, much better than we do. And we, lean on them heavily. Because it is a complex, opaque market. Now, our position in Sprott's and in the Uranium Participation Corp is a little different. We looked at this year and we see a very choppy market. And a very choppy market is very hard for investors that, say, have a 3 to 5 year time horizon, right? If you're like some sort of short-term trader, the chop is wonderful for you, right? Like there's a lot of volatility. But for us, we think 3 to 5 years in the future. And so this chop really doesn't help us very much. And trying to find a place to deploy capital on the long side this year that we don't think is going to hurt us, but we also don't think is extremely tied to overall market activity and sort of the risk on, risk off sort of emotions and narrative that people are playing that's driving the S&P all over the place, or whatever market you're looking at, is very hard. Now, the conclusion we've come to is that we think that the uranium participation or Sprott entity and European carbon allowances actually are two places where there is very little correlation to the market. We think the downside is extremely limited at the current prices, and there is a bunch of theoretical potential upside. Now, we don't have a timeline on it, and that's a problem for us. We like to have a timeline. But in terms of sort of inputting into your portfolio idiosyncratic upside potential in the context of this very choppy market where there's still a strong possibility that we have another leg down, I think that uranium and, again, European carbon allowances are interesting opportunities.
I agree with your remark that it's an opaque market, but isn't that almost as much of an upside as it is a downside to the investment, in that if you're willing to spend the time to educate yourself on conversion, enrichment, replacement rate contracting, and all these things, wouldn't that almost give you an edge in terms of performance over the market?
It might. It absolutely might. It's worth.
But is that realistic? Like, what I'm asking is, like, it could. I mean, theoretically, it would, right? But is it realistic for someone like me to do like home desk research and get there?
I don't see why it's not. You may need to spend some money to buy some reports, if you will. You may not be able to do it just for free with the information that you have available. You may need to buy reports from UXC or some of these other organizations, but there's no reason you can't. The question is how much value is it really going to add to your decision-making process? So you look at something like the Arrow deposit, next gen, right? The only question is, are they going to turn it on? When are they going to turn it on? Okay, when are they going to start construction? I'm not sure how much value knowing about that entire supply chain and things like that, is going to be in making that decision. It may be more important to understand how they're going to finance it, which is a very company specific question, right? So one needs to be laser focused when allocating capital on understanding what is the bet and what is the information I need to collect so that I can have an informed opinion about that particular bet. A lot of times I think people enter natural resources equities with an overarching thesis about the commodity. The challenge there, in my opinion, again, is that you basically have actually taken a derivative of the commodity price. So you spent, let's take copper, for example. You spend all the time in the world studying copper. You know everything there is to know about every use of copper there is. You have a supply and demand model, and you think copper is going to $8 a pound. Great. So now you've allocated money, and I've said this on some other podcasts before, you've allocated some capital to Freeport-McMoRan and maybe some junior development play like Trilogy Metals or something like that. You've added a couple. Okay. You're now betting on those companies' abilities to execute their business model within the context of what you think is an increasing commodity price. Okay. But all your time and effort has been spent on the commodity price. So did you execute your idea in the most efficient and effective way possible? That's the other thing about investing. It's not just about having the idea. It's about figuring out, how do I execute this idea with the tools I have available to me in the most capital efficient way possible, and in the most remunerative way possible, right? Because all of us, none of us are right 100% of the time. Okay, our batting average is about somewhere, it sort of moves obviously, but it's somewhere between like 55 and 60% of the time we're right. Okay, it's a pretty decent batting average. Okay, but what's the key? The key is deploying enough capital into the good ideas, and for those good ideas to make enough money that we can be wrong all that, the rest of that time. So it isn't just about having a good idea. It's about figuring out how to execute that good idea in the market in a way that will generate significant returns for you.
I think this also highlights sort of your strategy that I have from listening to those podcasts, the interviewers of whom, by the way, have done an amazing job interviewing you, to highlight that strategy of yours, where like you don't necessarily want to focus on one commodity and then find whatever is the highest torque in that commodity. You want to find good companies instead. Yeah. So maybe talk to me about the difference there in between what you call buying good things versus buying things well.
Yeah. So just to clarify a little bit, I'd love to take credit for that line, but it's actually a Howard Marks line. So credit, where credit is due. We think of ourselves as actually buying things well, not necessarily buying good things. Now, what does that mean though? When I say buying good things, I'm talking about, say, buying compounders, right? Say long-term companies that in the long term can reinvest capital at high rates of return and grow, organically via compounding capital. Okay, that's like a really good thing, right? That's what Warren Buffett buys. That's what very traditional value investors are looking to buy, unless you're the Graham and Dodd school, if you will. They're looking to buy those compounders. That's buying a good thing. Within cyclical markets, I would argue you can't buy good things, right? Which is not to say there aren't good companies, but there aren't really compounders, right? Every once in a while you hit an Exxon Mobil, okay? They happen, but that's more the exception to the rule, right? Most companies have a window of time where they can make a bunch of money. Okay? Now, the challenge with that for an investor who invests through cycle is that then, in order to capture that window of time when they are a good thing, you need to predict the cycle. I can't predict the cycle. What I can do is I can figure out where there's a significant gap between value and current market price, or between current market price and expectations about the future. And that can happen at any point in time. Okay, so we're not looking to just capture the value created during the good part of a cycle. Okay, that's betting on the commodity price for all intents and purposes. There's a window of time in which that can occur for commodity producers. The rest of the time, they need to be prepping for that period of time, or they need to be acquiring assets in a counter-cyclical way, or there are all these other things they can do. But so we're not buying a good thing. We're looking to buy things at good prices when there's a significant gap between current market price and expectations about the 2, 3, 5-year future. Okay, so buying things well as opposed to buying good things. I've said this before too, we're back at sort of the horse race track. Okay, and at the track, you're not necessarily looking to pick the horse that wins. You're looking to pick the horse with the odds that are most in your favor. There's a difference between those things. The horse that wins may not have great odds. It may, pay off 2 to 1, but the horse with odds that are most in your favor may pay off 5 or 6 to 1 or something like that. Those are the opportunities we're looking to capture. We're not looking to pick the horse that wins the race. We're looking to pick the horse with the odds most in our favor.
We've started talking about gambling, so this is sort of where my realm is. But aren't you betting on the uranium cycle or price with split?
No.
The split's not really a company.
Absolutely. And look, what I would say is when you build a portfolio, you have to recognize that there are multiple different types of return drivers in your portfolio. And you should look, in my opinion, to have multiple different types of return drivers in your portfolio. Now, to your point, that's just a straight bet on uranium price. No question about it. I'm not saying you can't do it. It can't be done. You shouldn't do it. I'm just saying that when looking at companies, there are other ways to do it than just betting on commodity price. Now, again, with uranium, we are making a bet on the commodity price. I'm not opposed to making bets on commodity price. I'm just not really thrilled with the idea of making a bet on a commodity price via equities. Why not just go to the futures market and bet on actual?
So, but why? Because with uranium, why wouldn't you want to torque it? Like, if you think the uranium is going higher, like, why wouldn't you want to put a torque in it and go for like an explorer? Because a rising tide, all boats, something.
I mean, again, so uranium's a little difficult because the futures market isn't there. But what I would say in general with that, my response to that in general across a broad sweep of commodities is, look, I can get 10-to-1 leverage in futures. If you think you've got more torque than that in a company, more power to you. I don't think you do that. To your point, uranium is a bit of a unique situation. But at least for us, again, it's a bit of this portfolio allocation. And part of our comfort with it is what we think the downside risk is. And the downside risk with a physical stockpile of uranium, in our opinion, is significantly less than the downside in a lot of the juniors within the uranium sector.
Okay, so give me some rope here. 3x leveraged spot. That would be pretty much the perfect uranium vehicle, right? Because you have almost no operational risk. Yeah. If the commodity goes up, spot goes up. It doesn't have to necessarily, but it's very probably gonna. And you don't have the operation, or you don't have the dilution risk, which you're absolutely going to go through with the lifestyle of the management of these companies too, right? What do you think about that?
So I've never done anything with these levered like 2x, 3x ETFs or anything like that. It's kind of an interesting idea. Yeah, I'm not opposed to it. I mean, I'm not opposed to anything. It's just you need to make a good argument for it, right? I think a lot of people, when they come to investing, they get a little. This may be mostly more on the value side, but they get a little ideological about it. I don't think there's a lot of room for ideology here. The fact of the matter is that there are people who do nothing but look at charts and make all kinds of money. There are people who do nothing but look at balance sheets and make all kinds of money. The key is not to pick one strategy or the other, but to be flexible enough and humble enough to recognize that we're in a game of sort of competitive learning. And we need to just continuously learn, continuously evolve, continuously adapt, have a couple of core concepts that we hold to fast. Ours is, we always try to buy $1 for 50 cents. But how that dollar is constructed, as long as you can construct that future dollar in what we think to be a rigorous case, I'm happy to buy that 50-cent dollar. If you can construct a rigorous case by pointing to nothing but charts, then you can construct a rigorous case. So one's got to be flexible, I think. And that's especially true going forward. Like, look, the last 10 years, most people probably were just best off buying the SPY and going home, right? I mean, look, I'll be very honest. It's not great for my business, but the reality is that we had a couple of years where the S&P put up like 30%. Look, you're not really going to beat that. Okay, that's great. And even if someone does and they do 40% and 30 instead of 30%, do you really care? Maybe a little, but you were up at least 30%. But going forward, if we're not in, a environment where the Fed has got our back, or where central banks in general have our back with low interest rates and easy capital, and we continue to have volatility, and we have volatility in inflation, which I have an expectation of, it's going to be harder. It's going to be choppier. And within that environment, sticking to one strategy all the time, or sticking to one thought process. I think that's the key. Sticking to one thought process all the time is going to be hard, because one thought process all the time just very rarely works. You need to have flexibility.
So what you're saying is that gold bugs don't have a high probability of being right. Because of how married they are to the idea.
Yeah,
that's what the joke that I made.
They're going to be right for some window, and then they're going to be wrong. And that, going back to uranium, that's been some of the challenge with uranium, right? Like, you've had, let's call it uranium bugs, and they've been in uranium for 10 freaking years. I've watched uranium for 10 years. I didn't pull the trigger until I got an opportunity to do something with to invest in the Kazatomprom IPO. Now, why did I pull the trigger at that point? Well, because Kazatomprom was a business that was going to pay me I think when it IPO'd, we got it at 10% dividend, right? Okay, so our hurdle rate is 14%. Okay, so the 10% dividend right off the bat basically clears the hurdle rate. They had a great balance sheet. They had a great business. All anyone had to do was recognize the cash flow at the current uranium prices at the time of the IPO, and it was a double. I didn't care what uranium did. So we pulled the trigger on that one. But that was the only time in the last 10 years I pulled the trigger on a uranium company, other than this most recent allocation to the Uranium Trust, which again is a bit of a different or unique sort of portfolio allocation.
Okay, so by the way, they call us utards, or we got to figure out how to say this in French. You a-holes, basically. Let's call it that. That's the gold bug equivalent for uranium investors.
Okay,
probably tells you all that you need to know about us, bunch. So
it's tough.
It is. What do you think is gonna give you the edge going forward, sort of over the immediate future? Like, is that financial? Like, would you be analyzing the cash flow statement and then doing DCFs? Is that still a thing that you think is going to give you the edge?
Yeah. So again, I think one has to be careful in differentiating between, let's call it, the tools and tactics that you use to create a valuation and edge. I think that from my perspective, I think mine should be analyzed on a DCF basis. That's the way we do it internally. I think that is a good approach. It syncs up with the type of business it is. The business tends to have a beginning, a middle, and the end. The mine has a life. A DCF, it's a project. Projects should be evaluated on a sort of net present value basis through a DCF. So I think DCF is the right approach to evaluating a mine, especially someone who's a company who's turning on a mine, let's say. But I would also suggest that edge is going to be found in the future going forward, I think, more so perhaps in the last couple of years, in being able to imagine more of the possible futures than people are used to, right? So, the last couple of years, everything's just, it's just gone up, and people's vision of what the future could be narrowed. As trends continue for longer and longer, the scope of potential outcomes actually increases, but people's visions of what they are kind of decrease. They narrow their line of sight. We try always to be betting on a spread of possible outcomes, right? So when we think about how much a company is worth, we will have multiple scenarios at multiple different prices, and then we'll subjectively weight them, okay? And then we'll combine all of that into one number. And if that one number, which is inclusive of a bull case, a bear case, maybe an ultra bear case, an ultra bull case, it could be any number of scenarios. If that one number that represents a spread of possible outcomes is higher than the current share price, then we'll make a bet, right? But if all we can come up with is is a bull case that, when combined with the bear case, does not lead to a higher sort of share price than the present, we're not going to make that bet, because you need to be able to recognize that if you're betting on a single case, you're betting on a single case, and you're going to be precisely incorrect. You may get lucky, okay, but you're going to be precisely incorrect. There are more futures out there than people include and people recognize there are more futures out there, but they still don't necessarily include them into their valuation. I mean, if you were to tell me about some company you were investing in, tell me the bull case, and then I said, are you 100% certain that's what's going to happen? You would say no, but you might make the investment with that price target, and that being your only price target. I would say that you've made an error there, because not only do you recognize that there's more outcomes than can occur there, but you've made a bet 100% on one outcome. Mm-hmm. I don't know if any of that made sense.
It makes sense.
About the probabilities can be difficult.
I like weighted averages, and I also like the first lesson that I wrote up, which is like stocks don't only go up.
Yeah.
You got to realize that too. But I like the weighted average approach. It's something that I would do, where I would give a probability to the value. So I would say, what's the probability that we go to that MPV? What's the probability that we go to that MPV? And then I take a weighted average at the end.
Yep.
And then I would take an EV to MPV multiple of that weighted average. Am I doing anything when I do that? Like, does that make sense?
So you ran a DCF.
I take the MPV that is that the company basically gives you with the final investment decision, or the DCF, the feasibility study, one of the feasibility studies.
And then you apply a multiple to it. I mean, there's nothing wrong with that. I mean, the wonderful thing about multiples, but also the difficult thing about multiples, is that they embed a whole bunch of sentiment in there, right? And when you think about the price of a stock, one should always, of course, think about the fact that it's more of a price stack, right? There's value at the bottom, and we'll call value that which is derived solely from fundamentals. Then you have sentiment, you've got market flows, etc., and that creates the price. And using multiples enables you to input some of that sort of sentiment or some of those other market factors into what is just a fundamental value that you probably aren't going to see very often be the actual price in the market, right? Because the value and the price are usually always going to be different. You hope that at some point the price crosses through the value, but it's never going to stop there, of course. It's never going to stop there because you've got these other variables in play in the price stack, let's call it.
Mm-hmm. So when it comes down to something like an EV to NPV, is that something you would look at and be like, okay, if this is like a 1.2, I wouldn't go in?
Yeah, I mean, we look at EV to MPV and variables like that. I'm not going to say at 1.2 I'm not going to go in, but it's just sort of going to depend. That's quite a situational question. So I'm not going to draw any hard and fast lines. But yeah, I would be a little surprised if I went in. But yeah, I don't want to draw any hard and fast lines though.
Because I watched an interview with a gold hedge fund manager, and he was talking about his analysis basically helped him sell Barrick at like $30 almost, which is pretty much the very top that he hit there, because he looked at a multiple and he was like, okay, if the market is saying this is worth twice the MPV, the market is assuming that like this no longer goes from an annuity. This actually goes from an annuity into a perpetuity. So the market is assuming that Barrick is going to be able to find new resources to mine and at the same efficiency as they have previously in perpetuity, which is quite the big ask. And he said, I thought that's pretty much impossible, so I sold my stock.
No, I mean, I think that makes sense. at the same time, so we invested in Barrick in 2018, right before they merged with Randgold when they were trading about $10 a share. We did so on the basis of a DCF that suggested to us that across a spread of possible gold prices, that it was worth $25. Once it hit $25, we let it run a little bit because things were hot and got out at around, I don't know, 28 or something. Mm-hmm. So I think there are multiple ways to do that sort of same analysis. Mm-hmm. But what you just articulated there does there's some logic to that. It makes sense to me.
Mm-hmm. Okay, I'm still trying to kind of understand it. By the way, I sounded way smarter than I actually am, is because I watched that recently and I've been sort of trying to think about it. But pretty much what we've been talking so far would almost necessarily exclude explorers. So if I understand correctly, you don't touch those.
We don't have a history. Like I wouldn't rule anything out. Mm-hmm. We don't tend to invest in explorers. And the reason we don't tend to invest in explorers is not because it can't be done well and it can't be done in an extremely remunerative way. After all, more money has been made with the drill bit than I think in other ways. The moves off the lows when you find something are bigger than when you turn on the mine. Like, I'm not going to deny that. We just don't internally have the skill set at the moment. We don't, I'm not a geologist. I don't have a geologist on staff. I've got a lot of experience with operations, a lot of experience with underwriting from a previous career in insurance, underwriting the ability of management teams to turn on infrastructure projects and things of that nature, which goes well with mining, and including some time spent looking at turning on mines within the context of insuring banks against project finance loans. So it's more of a skill set thing rather than anything to do with explorers per se, right? Mm. If I had more capital under management and could afford to bring a geologist on staff or bring, maybe it's not even a geologist, maybe it's just the right person who knows that side of the business better than I do and can support the analysis. I don't reject it. It's just we don't have that internal skill set at the moment.
I understand and I agree with that now. And I say now because it's after I sort of lost money there with it, because before I wouldn't have agreed. But now I understand that you have, on top of everything, on top of the operational risk, on top of the dilution risk and all the other risks that you have geological risk, and you have to be honest towards yourself like you are. Do I understand? Do I know how to manage that risk? Do I understand the risk that I'm taking? And in most cases, like with me, the answer is no.
Yeah, and in most cases with me, the answer is also no. Like the geological risk is we've got a play where we've already de-risked a lot of the geology. Otherwise, we are making decisions that we're not necessarily fully capable of making in the light of real honesty with ourselves about what we know and what we don't know.
Mm-hmm. Right. So like you're strong in finance, it would make sense to go for the pre-production sweet spot because you can, and then you apply the probability weighted average that you told me about, and then the strategy makes a lot of sense. What has that brought you in then? Now we sort of come full circle to the 40% materials, 30% energy, 30% industry. What is it, if we could go a little bit deeper on the materials side of things, what has it brought you in?
So at the moment, so we've got a position in Adriatic Metals. We've had that for a couple of years. Adriatic is a Eastern European polymetallic deposit. They've got one in Serbia and one in Bosnia. Mm-hmm. I think they're now there's a lot of silver in the deposit. There's a couple of other things in a couple of deposits, but they're getting ready to turn on their mine or their first mine. I'm not going to attempt to pronounce it because I'm terrible with names and I butcher them every time. But they've got a mine. It's going to be turned on later this year. or first quarter next year. I'd have to double check. So we're probably getting close to getting out of that, especially given sort of what I've been told is the sentiment around silver right now from people who spend more time looking at silver than I do. We also have two long-standing positions, one in Lithium America, which we've owned for many, many years, for three or 4 years at this point, and Equinox Gold, which we've also owned for many years. Equinox Gold, I was speaking with management yesterday. I told them I love talking with you guys. I love what you're doing. But in all honesty, I should have gotten out when it hit 15 or 17 last 2 years ago. It hit 15 or 17. I don't remember which. And I do remember and jotted down in my notes, should probably get out here, but I think gold is moving. And I then proceeded to hold it all the way back down to $3 a share. So, make mistakes.
That was like the summer of 2020.
Yeah, that sounds about right. So, you make mistakes. I still think Equinox Gold is worth something in the $15 to $17 range, but they've got to prove themselves, and I think they're doing that right now. They've had some political risk issues over the last couple of years, and there's a lot of skepticism about their ability to execute the build out of what's called the Greenstone mine in Canada, which is a very large Canadian gold mine that to date they have executed the build out of flawlessly within the context of rising inflation and costs, et cetera. But they've still managed to execute flawlessly. And a lot of people sort of question whether they've really been able to do as much as they say they have. I think they have. I've been to site, and the story all sinks and works. So we remain holders invested there. And then we've got a trio of Australian mining firms. No, actually, I talked about Adriatic already. We own Centamin, Centaurus Metals, which is a nickel company, building a mine in Brazil. We have what is, in fact, our earliest stage investment ever in ionic rare earth metals. That is very early stage for us, but what we like about that is you've got a lot of discussion about rare earth metals occurring, okay? But what people haven't done, it's kind of like uranium. You got to dig a little deeper. There are multiple kinds of rare earth metals, and specifically there are light rare earths and heavy rare earths. Now, besides the fact that rare earths in general aren't very rare, what actually is not very rare at all is light rare earth metals. There are deposits in the United States. There are deposits in Canada. There are deposits in Africa. They got deposits everywhere. What they don't have is processing capability. Okay, that's all in China. Now, what is interesting, though, is heavy rare earths. Heavy rare earth deposits are very rare. There really aren't that many of them. The reality is that all of the ones we are aware of are in China and Vietnam. We are actually only aware of 2 heavy rare earth metal deposits anywhere else in the world. One of which, Ionic, is developing into a mine. In addition, what's interesting is Ionic is moving towards a processing facility in the United States for heavy rare earths and have some very interesting technology on the recycling side. And so they've got a couple of different possible avenues, if you will, to monetize not only the asset that they've got, but some of the intellectual property that they own around processing and around recycling. So it's a bit more of a we're okay being early because it's a bit more multifaceted. We still have our position in Alphamin. We think the torque to tin price is remarkable, and that they've managed to, I first met Alphamin's management team in New York in late 2016. And it was a basket case for a couple of years in there. But we really like the management team currently and continue to hold the stock because we think there's going to be a long runway of capital return from them. They're going to pay dividends and continue to pay dividends for a long time into the future. And we think they have an opportunity to be one of those rare mining firms in a niche industry that just can continue to generate high returns on invested capital because their grade is so very high at their mine. So
you make interesting points. I looked for a while into rare earths, but then I decided that I sometimes joke that rare earths are kind of like women. They're not that rare, but they're very difficult to understand and difficult to process. My wife doesn't think that's a funny joke, but
I think that's hilarious, and I think that is spot on.
It's true, right? And then I sort of gave up, which I didn't do with women, which eventually got me married, so that's a good thing. But I'm looking at some of these companies. I was opening the charts here on my laptop, and it seems like a lot of them have already ran a lot. And I think there's some sort of a mental blockade in my head that looks at the market cap. It's that like Lithium America's $3 billion, which is pretty huge. And it sort of almost doesn't allow me to go in, especially after it's ran a lot and the market cap is that high. So
the question is, what is it worth? We think it's worth. We think that when Lithium Americas turns on Thacker Pass and they've got their assets in South America, and they're going to split the company in two, actually, and they've got a entity, Kuchari, in South America, which they're partnered with Ganfeng, feeding lithium into Chinese supply chains. And they've got Thacker Pass in the United States in Nevada, which is going to be the largest lithium mine in the United States or in North America, period, and are feeding into U.S. supply chains. And they split that company up into two pieces, and each one gets a small premium. And the U.S. one probably gets a big premium. We think that there's the potential for that combination to be worth more like $40 a share. And that's our blended case. Okay. Now let me dive into a couple of the really high cases, which are kind of interesting to think about. Okay. Thacker Pass is an interesting deposit because it's a clay deposit. And so the processing of the lithium is different than spodumene, it's different than brine. Okay, the clay deposit allows them to go straight to lithium, the processing of it, they can go straight to lithium metal. Well, if someone over the next couple of years figures out a good way to make solid state lithium batteries, and there are companies like QuantumScape and other companies like that working on that, our scenario, the value of lithium in Americas in that case is more like $100 a share. So yes, you are absolutely right. It has run a lot, but just because it's run a lot doesn't mean it can't run a lot more. The question is not what has it done in the past, it's what will it do in the future, and what it does in the future is going to be tied more to expectations and future value than what it did in the past. So, well, again, we think Lithium Americas is probably worth more like $40, $45 a share. But again, that's the blended case. And as you know, when you think in this scenario mode, what's nice about it is as companies accomplish different things, you can drop scenarios or you can add scenarios. And that's going to change your valuation. It allows you to be very flexible in constantly updating your valuation scenarios based on new information coming in. Now, the reality is that most of the time the value doesn't change. Okay. But something like the ability to go straight to lithium metals and someone like QuantumScape developing solid state lithium batteries, well, all of a sudden we can start dropping cases on the bottom end. And then our spread of scenarios, the valuation is going to go up. So we think there's a lot more room for Lithium Americas to run.
I think that must be some type of short circuit or whatever in my head that didn't allow me to think that way. I hope that gets cured by experience. I'm not too hopeful now, but it's true because you need to look at what's going to happen in the future and then what's happened before, because the contrary is true for me as well, where I would look at a stock that's already fallen 90%, and I'd be like, oh, interesting. But there's nothing to say that it cannot fall another 90% on top of that. And
there's
that
nothing to
hurts you a
say it
lot.
can't fall, and there's nothing to say that that fall wasn't justified. The problem or the challenge, I think, the challenge with being sort of value-minded is you do look at a lot of companies that have a lot of fleas on them, if you will. And, that cuts both ways. Sometimes the fleas and the sell-off are justified. So separating out those scenarios is, I think it's far more critical to be able to say no in some regards than it is to be able to say yes, because I look at a lot more ideas than I invest in. So it's critical. That ability to say no remains critical. But you do need to be looking forward.
Another good point, because sometimes things are cheap for a reason. Is that true? Like, are they cheap? Is that sometimes, or is that most often things are cheap for a reason?
I think most of the time things are probably cheap for a reason. Now that's just, it's a really hard question to ask. I say that only because I say no to so many more companies than I say yes to. Maybe the standards are too high. I don't know. I don't think so. I think having extremely high standards and saying the company either meets the standard or it doesn't is important. But my guess is that most of the time things are cheap for a reason. And that's why we say no so often.
Well, what about being contrarian then? Because Rick Kroll tells me that in the resource space, you either are contrarian or you will be a victim, is what he says. Is that, like, how do you manage being contrarian while also, bouncing off things that are cheap for a reason?
Yeah, I would tend to agree with that general sentiment. We try to be contrarian. Sometimes we are. Not every position can be a contrarian. Like, if you have a whole portfolio of nothing but contrarian positions, that's a very hard portfolio to live with. And you do need to be able to put yourself in a behavioral, in order to succeed. Like, there's a lot of behavioral issues with this game that we play, right, in the market. And in order to be able to succeed, you need to be able to remain even keel. I'm not sure if I had a portfolio of nothing but contrarian positions, I would be able to remain even keel enough to be to make thoughtful decisions. But maybe I don't know. Again, the contrarianness is about the conclusions. So you collect the information and you form an opinion about the information that you've got, and you need to take each piece of information and say, where is this piece of information coming from? What are the incentives of the person providing this piece of information? And how much value can I attribute to this piece of information? How important is it really? How trustworthy is it really? And if you can assemble the case, you can assemble the case. Now, you constantly need to be reevaluating those pieces of information. But we're detectives, right? We're searching for truth. It sounds a bit highfalutin, but we're searching for an accurate understanding of reality, and with that comes an understanding that sometimes the majority is not in the right. And the majority sort of forms the price, if you will, right, or on the margin. So I wish I had something more substantive to say on that issue, but it's pretty hard to have high conviction on a contrarian play, but sometimes it's the right place to be. You just need to keep doing the work until you have that conviction. But evaluating the conviction in your conviction is absolutely one of the hardest things to do, in my opinion.
I don't even know what that means. It was a little bit too meta for me. What do you mean?
Well, so like Okay, so let's say you have a portfolio of 10 stocks. Okay, you put 10 stocks in your portfolio. Do you have the same level of conviction on each idea? Probably not. How much conviction do you have in your conviction? Right? You say this company, Lithium Americas, is worth $40. Okay, in my mind, or $45. How much conviction do I have in that? And is that conviction more or less than my conviction that Equinox is worth $15? And some of that is going to change, how much capital I allocate to those ideas. Like if I have high conviction and I have high conviction in my conviction, I can overweight the ideas I have high conviction in. Me personally, I don't really have a lot of conviction in my conviction. So all our positions start at 6%. I don't attempt to say I have the most conviction in this idea and the least conviction in this idea. So I'm going to put 10% of the portfolio in that idea and 2% of the portfolio in that idea. I just know that my ability to judge that is not good. And so rather than I try to work with that. And by trying to work with it, I made the decision that I start all my positions at the same size.
Okay. But so your portfolio never really goes under like 15 holdings or something like those lines.
Yeah, we have between 14 and 16 positions on the long side at any given time, and roughly the same on the short side.
That's pretty concentrated though for a money manager, right? I mean, you look at someone like Joe Greenblatt or whoever, and they have like 5,000 on there.
Yeah. No, I think I know a couple of people who run books with less than 10 positions. I don't know how you do that. I know people that run. I think more people run books that are a lot bigger than ours, though.
Okay, that's also a good point. I think actually mentioning Stanley Druckenmiller, who's by the way recently bought Cameco, so uranium stocks. I mean, in his last quarter, and he's what's that 17? Is that $17 billion that he managed? Something along those lines, right? And then he's got like 58 positions, which is for the amount of money that he manages. It shouldn't be. I don't know how much. I don't think it's 17 billion. But anyway, it's a lot of money that he manages, $1 billion that he manages, right?
Yeah. It sounds about right.
I don't
know.
Yeah. What about, because when I look at something like natural gas, for example, my contrarian spidey senses start tingling a little bit, but it also seems like it's going to zero, because every time I think like, okay, now it's really cheap, then it drops another 10% on a day. So
natural gas. Yeah.
Because you said 30% energy.
Yeah.
Isn't it like, when you say that, what's that? Coal, oil, natural gas, uranium, what else?
We put renewables in there. We also throw utilities in there because we invest in utilities, and we think of electricity as energy. So why has it got to have its own? Why has it got to have its own sector? But I mean, we've got a position in Equinor, long-time position in Equinor that we established. Well, I guess it's not too long at this point, three years or something. Bought it in the depths of COVID. So we get natural gas, plenty of European natural gas exposure there, but plenty of oil exposure there also. I would. So my contrarianness also starts to get tingly when I look at natural gas right now. At the same time, I also know natural gas is extremely volatile, and that I saw some evidence recently that a lot of U.S. fracking wells are getting increasingly gassy, which is sort of bullish for oil, but bearish for natural gas. I struggle with the idea of natural gas having much downside risk from here, just because there are so many demands for it. But I don't know. I think I think natural gas is a really hard call right now. And it is not natural gas is really not my area of expertise. I watch it carefully because we have several companies with exposure, but I can't claim to have as nuanced a perspective as others would have. And so I'd say, yeah, I am feeling contrarian when I look at natural gas also. But I don't have high enough conviction on any of my natural gas thoughts to really make a play at the moment.
But it's kind of tough too, because it seems super easy at first, because you think like, okay, what influences the price of natural gas? Like weather does, but also, production levels, storage levels, supply and demand, and all these things are sort of pointing towards it. Maybe not because we have warmer weather than expected, so lower demand than expected, but countries are ramping up supply to be more independent from Russia. Storage levels pretty full over here in Europe, right? And stuff like that. But at the same time, then you also have something like the marginal cost of production almost topping everything off, where you say, oh, but we're nearing that. We're almost under, I guess. Well, if you bake in inflation, probably the last numbers that I saw, if you bake in inflation, is that we're probably under the.
Yeah, I would be surprised if, hold on, where are we at today here?
We're under $3, I guess.
Yeah, I mean, I'd have to look it up, but I would be.
Oh, we're at 250 actually. Oh,
yeah,
wow.
We're at two. Yeah. I'd be surprised if at 250 there weren't people, say in the Marcellus or where the Utica, wherever you are, who are slowing drilling or maybe shutting off wells. 250, not a lot of margin in it there. I would think, for most producers. With the exception of perhaps a couple of companies that are feeding into Europe directly, where there's going to be more margin, different cost structure. But in the United States, it's tough to be a natural gas producer right now.
Also, production is a big transportation is a big thing, right? In natural gas, something that is
it's a massive issue in the United States. I mean, the various different fields. It's like a merry-go-round. It's a different field every year that's running into some production or an export bottleneck, if you will. And the ability in the United States to get new pipelines built, it's just really hard, especially if they have to cross state lines. You're talking years of permitting, and it's a bit of a nightmare. I mean, to the point, there's a pipeline in the United States called Mountain Valley Pass, which is being built, and it is something like 95% built at a cost of it's like $5 billion or something, and they've been sued to halt completion, and that completion has been stalled 2 or 3 years now. Something like that. It might even be 3 or 4 years. But it's been stalled and tied up in court for various environmental reasons. But it's 95% done. They couple of months to finish it, type of thing, and they are not being allowed to finish it. And I wouldn't be surprised if it never gets built. Or never gets completed.
I guess within that topic, I also didn't hear anything about coal and oil. There is that something that you say like, okay, we have renewables in our energy pot, but so we don't want to put coal and oil next to it.
No. I've made some good money in coal in 2016, 2017. Admittedly, I've made no money in coal recently, mostly because I was just sort of focused on other things, and the team focused on other things. Don't have an issue with it. I don't think this will be controversial, but I think we have the tools we need to move away from coal as a society, if you will. Now, whether we deploy those tools to do so, I've got, that's a bit of a political question. It doesn't appear to be occurring in my mind. So I'm not all that interested in thermal coal, especially given the moves it's made recently. But metallurgical coal is still interesting. And we have plenty of investments in oil. I guess not at the moment. We don't have many. We have a position in Ecopetrol and we have a position in Equinor. and those are our two oil positions at the moment. But we don't have any issue with oil. I think it's sort of interesting when people talk about transitioning to a low carbon economy. Everyone thinks it's, or not everybody, but a lot of people seem to think it's just a very simple process. We're just all going to drive EVs and we're going to get renewable power and it's done. It is so much more complicated than that. And from my perspective, oil might be the most critical commodity to transitioning. Okay, why? Because right now the entire economy runs on. And if you don't have a humming economy, this transition to a low carbon economy will not happen. Okay, it is a transition that touches quite literally every element of the economy. If you are really talking about transition and not talking about, say, just transitioning the electrical grid, but chemicals, steel, cement production, all these different things, you want to get to net zero, it touches everything. If you want to change that which touches everything, the economy has got to be humming. If the economy has got to be humming, at this point right now, we still need oil. It's just the way it is. You may not like it, but it is the way it is.
I agree with you. Absolutely. And I've been looking for ways to expose myself to oil, keeping in mind my personal limitations of the knowledge of the market. And my eyes fell on Petróleo Brasileiro, or however you pronounce it.
Brazil, PBR, yeah.
PBR. And you mentioned Centaurus, which I guess Centaurus is in Brazil, right? One of your picks. So how come, I mean, if Brazil is not stopping, because that's what's stopping most people out there, right? To go into PBR, because the dividend is expected like 50% or something. So
we are doing due diligence on PBR.
Oh, okay.
That's sort of as much as I'll say at this point, because I don't have a lot of conclusions. I try not to form my conclusion as much as possible until I've done enough work. I don't think I've done enough work. But in regards to the political risk in Brazil, I don't have anywhere close to the concerns that other people do. I'm not sure why this sort of second coming of Lula has concerned people as much as it has. They have a pretty robust democracy. Lula is not Hugo Chavez. Okay, he's not, and just like in Colombia with Petro, he's not Petro's not Hugo Chavez either. Colombia and Ecopetrol sold off on political risk issues also, in my opinion. Neither of those guys is Hugo Chavez taking the country down some path to banana republichood. And the political risk concern, I think, has been overblown.
That also seems to be consensus with the locals too. I met a doctor from Brazil, also an investor, and so I interviewed him as well. And the Brazil issue the day that Lula got elected, and he said, like, look, he's not a dictator. He wants to run something. He has to run it through Congress, and Congress is pretty democratic. Like, he was like, listen, we're a decent country. I know most people in North America don't want to believe, but we're an actual decent country.
I was in Brazil during the first round of the election this year. First round. Yeah, it was fine. It was great. I walked around. It was, hung out with people during the election. Everybody's waiting in line to vote. Like, it was great. It was fine. There's no issue. And look, there are some concerns about taxes and things of that nature. And maybe raising taxes on, and I think Ecopetrol is a wonderful example of this. There was tremendous concern about raising taxes. Okay, great. You have concern about raising taxes. Got it. They did pass a tax bill. Okay, and the impact on Ecopetrol is going to be something like 5 to 10% this year. Okay, so it's not nothing. Okay, but the stock was more than cut in half. And then you look at it and you say, okay, well, what are the multiples it's trading at? Let's go back to that conversation about multiples and whether the sentiment built in to the valuations makes sense. Okay, well, you look at something like some of the Chinese oil producers. Okay, some of the Chinese oil producers are sanctioned by the United States, and yet they trade at higher multiples than Ecopetrol does, out of concern that the government in Colombia is going to tax them into oblivion. Or take something like BP or Equinor. Equinor is taxed at a rate of 75%, basically. The taxes are crazy. And yet you're dropping Ecopetrol and cutting it in half because what ends up happening is a tax bill passes that over the next couple of years is going to increase their tax bill from like 35% to 40%. And yet the multiple Equinor trades at is significantly above that of Ecopetrol. There are these weird disconnections when it comes to political risk that occur that cloud the judgment of people that are traditionally more quantitatively driven, right? In finance, we're all quantitatively driven. Okay, well, some issues are qualitative. Political risk is a qualitative issue. And it does create some opportunities. I think Petrobras might be one of those opportunities. Obviously, I think Ecopetrol is because we're already invested.
Okay. Well, thank you. I guess we can keep talking forever, but I booked 1.5 hours. We now are over it. So thanks a lot for doing this. Is there, what am I missing here? We talked a lot about about a lot of stuff, but what am I missing? What's something that you want to talk about and didn't bring up?
No, nothing comes to mind. We did a great sort of around the world tour there. So it was a good conversation, and I hope your listeners got something out of it. You can find Massif Capital, my fund. We produce a lot of research. We make it all publicly available. I'm on Twitter at WM Thomson 22. Tweet a little bit, but reach out if you're interested in learning more about us, and that's about it.
Okay, there's a minimum, I assume, when it comes down to accepting investors. What's that?
So in order to invest in a hedge fund in the United States, you need to be an accredited investor at a minimum. And our minimum investment is about $1 million. We do have an offshore entity we're starting up. We've got a lot of potential investors coming over from Europe who are going to be in that. I don't know what exactly the requirements are in Europe, though. I'd have to talk with our regulatory sort of people, but the minimum investment would still be about the same $1 million.
Okay. Well, thanks for sharing that. If I end up employing some of the things that you taught me today, maybe one day we can talk. Not right now, though.
Sounds good. Sounds good.
Thanks a lot for doing this, sir.
Absolutely. Thank you.